Hello everybody. In this session we are explaining about the cost concept. Cost is the total of all expenses. It is expressed in monetary terms. The cost concept in economics states that all accounts are recorded in the book of accounts at their purchase price. This includes the cost of acquisition, transportation, and installation, and not at its market price. The producer has to incur costs to earn revenues. The producer allows the outflow of the money for the sale of the product. After the sale of the commodity, the business gains an inflow of money. In other words, defined in economics, the cost is the sum total of explicit costs added with implicit costs. Over the years, the cost concept has evolved as more refinement was brought into the process. And then we move to the characteristics of cost concept of accounting. The first characteristic about historical costs. The cost concept primarily focuses on recording assets and liabilities at their original purchase costs. This value does not change over time in the company's accounting records, regardless of changes in the market value of these assets or liabilities. The second, regulatory acceptance. This concept is widely accepted and adhered to in many accounting frameworks and standards, making it a universally applied principle in financial reporting. And then the third, objectivity. The cost concept emphasizes using objective, verifiable evidence when recording transactions. This means that transactions are recorded at the amount that can be substantiated by documents such as invoices, receipts, contracts, etc. This objective value and nature helps in maintaining consistency and reliability in financial reporting. The fourth, limitation not reflecting current value. A significant limitation of the cost concept is that it does not reflect the current value of assets and liabilities. Over time, the relevance of the historical costs can diminish, especially in the case of long-lived assets or in times of high inflation. Fifth, stability of measurement. By recording assets and liabilities at their historical costs, this concept provides a stable basis for measurement. This stability is important for comparison purposes over different accounting periods, as it avoids the fluctuations and uncertainties associated with market or fair value measurements. The sixth basis for accounting policies. The cost concept forms the basis for various accounting policies and practices such as depreciation, amortization, and impairment of assets. These policies are applied to the historical costs of assets systematically, allocating their costs over their useful life. Seventh, prudence. The cost concept supports the principle of conservation or prudence in accounting. It does not recognize any anticipated profit but provides for all probable losses. For instance, if the market value of an asset falls below its cost, the loss is recognized, but increases in market value are not recorded until realized. Eighth, simplicity and understandability. Recording transactions at historical costs makes accounting simpler and more understandable. It avoids the complexities associated with other valuation methods like fair value accounting, which requires frequent revaluation of assets and liabilities based on market conditions. And then we move to the types of costs. The first types, accounting costs or explicit costs. The costs of production, including employee salaries, raw material costs, fuel costs, rent expenses, and all the payments made to the suppliers from the accounting costs. Second, variable costs. These costs vary with output and are known as a variable cost. For example, salaries of the employee, raw material costs all fall under variable costs. This directly depends on the fixed amount of resources. This is economic costs or implicit costs. According to the modern theory of costs, in economics especially, the investment return upon of a businessman, the amount that could have been earned but not paid to an entrepreneur, and monetary rewards for all estates owned by the businessman form the economic costs. These costs include accounting costs and the money also returned which the owner could have earned from elsewhere apart from the business. The fourth, fixed costs. Such costs do not vary with output and are fixed expenditure of the company. For example, taxes, rent, insurance are all fixed costs as they do not vary within a constant capacity. The company cannot avoid this cost. Fifth, outlay costs. These are the recorded account costs or actual expenditure spent on wages, rent, raw materials, and more. Six, indirect or non-traceable costs. These costs are not related directly or identifiable to any operation or service. Costs such as electric power or water supply are some examples because these expenses vary with output. They generally have a functional relationship with production. Seventh, opportunity costs. These are the missed opportunity costs. They are not recorded in the account books but show the cost of sacrificed or rejected policies. And eighth, direct or traceable costs. These costs are easily pointed out or identified expenditure such as manufacturing costs. Such costs cater to specific operations or goods. I think it is enough for this time. Thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.